Rising rates, it's really the story of the market this week, or the last couple of weeks, I should say. Higher yields putting pressure on those growth stock names, big tech. We saw a lot of pressure in some of those names this week. We want to help, I guess, have a better understanding of all that. And for that, we want to bring in Brian Cheung, who has been closely following this story for us. And Brian, we talked about Jay Powell's comments yesterday, clearly spooking investors a little bit, but talk to us just about some of the dynamics at play in the market and why we're seeing the various reactions that we have been over the last few trading days.
Yeah, absolutely. And it looks like to anyone that's watching the stock market on the surface that things have kind of reversed. There was a lot of green in the equities market. But I pointed this out yesterday. There's still a very strange dynamic going on between the risk on, risk off dynamic that you usually tend to see between equities and bond markets. So when you look, for example, at the green across the major equities indexes, usually that type of risk on, when people have the appetite to want to buy into stocks, you see bond market yields go up on US Treasuries. That's not the case as we see in the 10-year. Now, if you're looking at a day-to-day comparison, it does look like bond yields are going up, but consider that we opened the market session today with the 10-year yield going up as high as 160 basis points. Actually, since the market's been rallying across the day, we've seen bond yields come down about 5 basis points. So again, bond yields going down as the equities market goes up, some very interesting dynamics there. One explanation might be that people yesterday with that sell-off were basically doing profit taking, deciding that they wanted to cash out at those high valuations because maybe the Fed punch bowl at some point will get pulled away. So they pulled out of particularly bio and tech stocks specifically, which might explain why maybe the NASDAQ itself has also been lagging despite that market rally today. But very interesting dynamics. Things are still a little off, in my opinion.
Brian, we keep hearing people talk about yield curve control. Can you put on your professor hat and school us on specifically what that would look like if the Fed were to go there?
Yeah, absolutely. Well, let's first of all take a step back and think about the context of what we're talking about here. So I have a chart here that shows you the 10-year yield and how that's really steepened the yield curve. Now, again, for people that are unfamiliar with the yield curve, it's essentially plotting out the different types of yields from short-term duration, as short as 3 months, to as long as 10 years, or rather 30 years. And you can see what's the difference between the yield curve as of yesterday, the snapshot as of March 4th, and the purple line, which is a snapshot as of 2 months ago, January 4th. You can see the short-term end of everything's still pinned down to near zero. That's because the Fed slashed short-term interest rates. But the 10-year has really rallied up just in the last 2 months. Now, everyone knows that the bond yields generally serve as a proxy for interest rates. So this means more expensive 30-year mortgages. This means more expensive 10-year business loans. So at what point do those borrowing costs get so high that the Fed maybe wants to do something? Well, one option would be yield curve control. They just commit to buying a certain amount of treasuries until yields go below a certain level. And in fact, the Reserve Bank of Australia tried something like this with their 3-year bonds. They've been buying those bonds at a pin target of 10 basis points on their 3-year. But I want to show you a second chart which shows you the differences between where the 10-year on the Australian bond has gone and the 10-year United States Treasury. Very interesting to watch here. So again, the Reserve Bank of Australia is buying medium-term bond yields, trying to pin those yields down. But over the last few months, you can see the Australian 10-year has actually risen even farther than the US 10-year has in terms of basis points. So we're talking about longer-term borrowing costs going up. The same story in Australia, even with a yield curve control policy. So that's not to suggest that yield curve control policy doesn't work, but it's a cautionary tale for the Fed to say, hey, in this type of environment, there are many other factors that play in the bond market, which means you should be weary of maybe pulling out a new tool like this.
All right, Brian Cheung, thanks as always for breaking that down for us.